Hey, this is Jeff Beck, and I am with a national company, Symmetry Financial Group, and I work as an independent agent. And what I do is I specialize in cash value life insurance, IUL, and whole life. And what I'm going to do is I have a person that I know, and I have set up a program for him with cash value life insurance where he is wanting to pay off some of his bills and to stockpile more money into retirement and see just how much he can have in retirement. Now, this is a 32-year-old, and he's working as an auto mechanic, an electrician, a plumber, or whatever. And he's out there working that hourly job, and he's got some bills, say a car payment, dental bills, uh, toolbox bill or van payment for if he's a plumber or an electrician or a day worker or whatever. Well, he's wanting to have $1,700 where he can use that $1,700 in cash value every month to pay off his loans. And you can also use this to pay off your house if you want to, or you can do a big bundle where you do your house, your car payments, dental bills, school bills, whatever. It all depends on what you want to do. But I'm setting this up for him. He's wanting to have $1,700 every month that goes into his cash value that he can use to pay those monthly loans and bills. So let's get into this. I want to share my screen on how I set this up for him. Now, cash value life insurance, there's a different ways that you can use this. You can use an IUL or a whole life. Some people will like the IUL, some people like whole life, but it's basically the same thing that, well, not really the same thing, but it's cash value. That's the program, the cash value. They both have different pros and cons. But what I do is I help you to understand what the pros are and what the cons are for each one. And that way you can pick the one that you want to use for yourself. Okay. Well, I want to share this with you. Let me start sharing my screen here. Now, keep in mind, I've dealt with cancer. So, sometimes my brain and my mouth are not on the same page. So give me a little leeway here. Oh, wait, hold on. I want to share this, but I want to share it where you can see it really well. Okay, there we go. Now, can you see my screen? And can you see that really, really well? I've made it bigger so that you can see it. Now, you'll notice here that, like I say, he's 32 years old, non-tobacco, and he has decided that he's going to take about $550 a week and put it into his retirement. Okay. Now realize this is money that is not locked up like it is in a 401k. He has access to it. Okay. I want you to notice that for this 200 or $2,200 a month, he has a face amount of life insurance for $689,000. Okay. So if something happens to him with this retirement, it does not go through probate. It goes right to his family. If he's got a wife and three kids or whatever, they will get the $689,000 tax free right to their checking account. So it will help pay their mortgage, pay some of their bills. Okay. And that's one of the reasons, that is the main reason why people choose the cash value life insurance idea to help save for retirement because it goes directly to their family if they die, right? Now, I want you to look down here. I'm going to highlight this in blue. $251.77. That's what you're paying every month for the life insurance. So that's the charges and expenses. It's $251 a month for the life insurance. So he's going to have about $1,900 going into his cash value every month so that he can use that to pay his car payment, his toolbox bill, his van payment, motorcycle payment, or whatever he wants to use that for. Okay. Now, um, that's what you pay in order to keep. So if you run into a problem, if he runs into a problem, he doesn't have to pay that $2,200 every month. He can call this insurance carrier and say, I've lost my job for the year or whatever, and I'm trying to find another one. Let me pay the no lapse premium of the 251, and then when I find another job or whatever, I will start going back to the $2,200 a month. So this is very important. If you have this life insurance program with this, if something happens, you can pay the $251 a month. You don't have to cancel. You don't want to cancel this because there are consequences if you cancel this. Okay. Now, uh, let's go to page 7 here and see. Now, the way I've set this up, this is the interest crediting options. With the cash value life insurance, you're either going to be in the index or you're going to have dividends from the whole life. And what I've done is I like to keep it diversified. So I've set it up to where 33% goes into Morgan Stanley, 33% goes into BlackRock Advantage, and 34%. So there's three. Now, with this, if you want, you can have four, you can have five, you can have it in one. Some people will choose different ones. So it all depends. But this is something that is where the crediting comes from. All right. Now, let's go to page 9. 9. Page 9 here. Okay. Now, this is the historical performance on the stock market. It shows you here, like in 2001, the stock market fell 13%. And in 2002, the stock market fell 19%. Well, if you have a 401k or an IRA or anything, that's going to affect your IRA, your 401k. It's going to lose money, right? Well, you'll notice over here in the S&P 500, the next column, it talks about the annual point to point. It's 25%. You still gain 25%, even though there was a 13.55 loss. All right. And over across that row, it's 25%. Well, it's 0.25%, 0.25%, 0.25%. So that's a quarter of a percent. But the reason why people like this is even while they're in putting money in to save for their retirement, when they put it in, they're not losing it the next month because the market has gone down. And a lot of times, if you put money in one month, you'll see that the next month it's gone because the market has gone down. Now, that doesn't happen very often, but it will happen in some cases. that's why people like the cash value life insurance idea for retirement because you don't lose your money in the market. And you'll notice here that in 2003, the market was up 17%. And then S&P was 12%. And in another column, it's 9%, 9%, and 10%. That's why I say, diversify, put it in different uh, crediting options. And then you go on down and you keep going on down. And in 2022, it was 17%. Well, it's still 0.25% gain. And the average down here, I want you to notice the average. The average is 7.89. But up through some of these years, you've gained 12%, 12%, 12%. Even in uh, 2020 and 2021, 2022. In 2020, it was 12% gain. In 2021, it was 12% gain, right? But in 2022, it was a 17% loss. And in 2028, it was 39% loss. Now, how would that loss of 39% affect your 401k or IRA? If you lost almost 40% of your IRA or 401k, but you still had a gain of 0.25%. Now, when you got these low months or these low years where it loses, that's when you don't want to take a lot of money out of your 401k or your cash value life insurance. And I'll show you a little bit more about that. Okay. Let's let's go on to page 10. Wait, page 10. Okay, this is the accelerated benefits. This is the living benefits. There's multiple reasons why people choose the cash value life insurance. One, it passes on your wealth onto your family without taxes and without probate. And another one, it's a life insurance policy where they get it. And it also has built-in critical illness and it has built-in terminal illness and chronic illness rider. And this is something that you can use for long-term care if you need to, right? If you get cancer, you can access the money, the life insurance while you're alive to help you fight the cancer. You can also use the cash value life insurance to fight the cancer. And the critical illness covers heart attacks, major organ transplant, um, arterial aneurysm, central nervous system, and invasive cancer. Okay. Now, let's go to page 11. Okay, now this is where the nuts and bolts hit the road. The tire meets the road here. Okay. Now he's putting in $550 a week toward his retirement savings. Okay. And all total, what he also did was to start this to help with the $1,700 a, a month. He put in a $2,500 from his bank into here. What bank, if you have $2,500 in there, will give you a death benefit of $714,000. Okay, and you'll notice that this is grew from the initial 698, and that's because it grows. the insurance grows as you keep putting money in. Okay, so he's put in 28,900. Okay. He put an extra 2,500 in there to get this 1,700 going pretty good. And his account value at the end of the year is $24,555. His surrender value is 1,700 or $17,000. And this is where he's going to be taking his money from, the surrender value. And I just want to point out here, this is something that you don't get started into, and then a year or a week or whatever, you decide that you don't want to do this. This is something that I want you to take the time and decide that you really want to do this, because this is a commitment. Okay, this is a commitment. It's going to help you in the long run. It's saving for retirement, and it's also helping you to have a mortgage protection. If something happens, you won't lose the house. All right. Now, you will notice that he's paid in 2,800 or 28,900, and his surrender value is 17,423. Okay. Now, this is very important to understand, that surrender value. If you decide, or he decides, that he's done this for 2 years, say he's done this for 2 years and says, "Hey, I want out of this. I decided I don't want to do this." All right. Well, he's paid 28,900 every year, right? Well, if he decides he doesn't want to do this, he will get a portion of his cash value back. All right. So what he will get back is 44,120, because there are insurance costs and fees that cover this $714,000, and then the $740,000, right? So when I'm talking with you, I make sure that this is something that you want to do as a commitment for life. And if something happens that you can't pay the 2,200, remember, you can always go back and keep it in force just by paying the no lapse premium, which is 200 and some dollars. So if you get in a bind, don't cancel. Don't cancel. Call the insurance carrier or call me. All right. Now, um, I want to share with you how that, he's paying this 2,800, 9,000 or 28,900 every year. And what I set him up for was, he was paying $550 a week, right, toward his uh life insurance and his cash value, right? $550 a week. Well, there's only 12 months in a year. 12 times 4 is 48. There's 52 weeks in a year. So that you're getting paid. So what I did was, I took the 4 weeks that he is paying extra into his retirement savings account. I took those extra 4 weeks and added those in as a lump sum investment, or a lump sum where he puts that into this policy every year. So it builds cash value faster, right? And it builds that life insurance program faster. So that's how he's paying the 28,900 every year. And by the time he's 42, he's going to have $1,032,274 life insurance policy. And that's not going away, right? It's not going away. And his account value is $342,468,000. All right. Now, I want to I want to go down here to look at where he's 60 years old, okay? I want you to look at this column. Over here, where he's 60 years old, he's got 2,213,977. Now, these numbers are not carved in stone. Life happens. If something happens, you have more years where you're only getting 0.25% insurance charges and life happens. These numbers are not carved in stone. But with this, it's talking or showing that he has 2,213,977. So if he decides that he wants to retire at age 60, if he takes 5% of that, just 5% of that, that's $110,698. And what I recommend is when you take money out for retirement, you take half of it or a portion of it and try to double it, right? And put it right back into your cash value. You can take it and double it and put it back in. You could live off 50,000 and take 50 or live off 60,000 and take that other 50,000 and double it and put it right back into the cash value. You want to constantly be refreshing your cash value. I call it recycling the money. Recycling the money. Just keep putting it back in. That way it'll keep constantly growing, right? And even if you take like the middle column here where it's 1,542,000 and something, if you take that and you take 5%, they recommend 4%. And keep in mind, this does not go on your taxes. It does not affect your Social Security when you go to retire at 65. It doesn't show up on your taxes, so it doesn't affect your Social Security. You don't have to pay back a dollar for every $2 you made, because if you took 77,000 or 110,000, what you're going to have to do is you're going to have to pay back if Social Security is still around, you're going to have to pay back everything that you get from Social Security, because for every $2 you make over a certain amount, you got to pay a dollar back. Well, you could wind up paying back every dollar that Social Security gives you. That's why a lot of people like this. More and more people are using this as a retirement idea. Okay, let's go on down here to page 12. Now, the way this is showing, if he waits, well, I set it up to where he would work until he was 67. You don't have to work till you're 67. I can change this, but he was going to work. He enjoys his job. He likes working. Of course, when he gets to the 65, he may decide that he wants to retire before 65. You know, he may decide to retire before 65 with the money. But according to this, and remember, this is not carved in stone, if everything goes, Murphy's Law doesn't hit these numbers. If Murphy's Law doesn't hit these numbers, at the age of 68, he's going to have $4,193,000 in his surrender value. Okay. And his um life insurance policy is going to be $4,948,000. $4,807. Okay. And it shows here that if he wants to, he can take out $402,000 every year until he's 92 years old. That is only if Murphy's Law does not affect him. Okay. And I don't recommend that. And if you do that, you should take out that $402,000, take half of that and double it and put it back in here to help pay for the insurance and fees and stuff like that. Okay. Now, and like I say, how well could you live on $402,000 a year, even if you took $102,000 out of this? That again, you know, you can take as much, well, up to that amount, or you can take less. And remember, that $102,000 is going to trigger if you got this in a 401k and you take it out of a 401k, that's going to trigger a tax event, and it's going to affect your social security. It's going to affect your income taxes. You're going to have to pay taxes. That's why a lot of people are moving toward this idea. And now I want to say, if you have this set up right and you understand the rules and the way to play the game, you can make this. But don't get into this thinking that it's going to be a short term or anything like that. This is for the long game, the long haul. If if you one of the major things that a lot of people have heard is that, well, they don't work. They will crash. Yeah, they will crash. You know, you got to understand the the moving parts. And once you understand the moving parts and you do a yearly review of it, then you can make sure that it stay on par. This is not something that you set it and forget it. This is something that you want to keep track of every year. You see how it's growing, you see the expenses, you see how much you're taking out. And if he's taking out these loans every month, or taking out this money every month to be able to pay his debt off and get higher a retirement, you got to stay on top of it. This is not something like the cash value for the whole life is you can set it and forget it. But the cons of that is you don't have any flexibility. This is flexible. The main thing between the two is one is flexible and one is not. Okay. Now let's go to page, let's see here. Let me get my bearings. Let's see this. Let's go to page 15. Well, we've discussed that. That's 15. Now this is something that you want to understand. I mean, it's here. It talks about the loan and withdrawal details. This is where you're taking out the money and what it's costing you. And this is why I say, you take out some of this money, you want to double it, right? Take a portion of that 402 or the 102,000, live off of it because you don't have to pay taxes on it. Take a portion of it, double it, and put it right back in here. Recycle it. Keep recycling every year. Okay. Keep recycling every year. Now, let's go to 23. 24. Let's go to 24. Okay, now here is something that I want to share with you. Um, this is talking about the monthly minimum no lapse. That's it, right? Wait, that's it, right? Oh, come on. That's the monthly no lapse premium. If you're having trouble or he's having trouble with this and he's without a job, you can call the carrier and say, "Hey, I want to be flexible here. I don't want it to lapse. I I want to be able to keep this in place. And will you switch it down to where I can pay the monthly minimum, no lapse, the 251." And the carrier will say, "Yes, you can pay the 251. It's flexible, right?" Now, remember, I told you that the first year lump sum, he put in $2,500 to get it set up for that $1,700 a month that he wants to use to pay his uh, monthly bills and to help pay it off and stockpile more money for his retirement. And over the years that he paid that extra 4 weeks that he put in as a lump sum in the year, that total lump sum amounted to 87,500 over the years. Okay. Now, now here's what the charges and expenses. Okay. It goes over, you paying in 28,900. The premium expense charges, the cost of insurance, the expense charges, and the total expense for the life insurance for $714,000 is 4,425. And you'll see here that the cost of the insurance goes up some. But the reason why it's going up is because I've set it up to where the life insurance, the death benefit is increasing. So the cost for the insurance, the life insurance is going up, right? And then you see here in uh year 20, the cost of the insurance isn't as much. It's going down because a lot of the insurance, you're paying for more of the insurance in these first 10 years, or he's paying for the insurance in the first 10 years. And here, the total expense is 3,000 when in the first year it's 4,000. That's because cost of the insurance. He's got $186,000 or $185,000. No, $1,085,000. And his life insurance policy is 1,933,000. And it just keeps going. It shows you. That's why you want to keep up with the expenses, right? And that's why I tell everybody you want to take a portion of whatever you're taking out in retirement and double it and recycle it back in, because when you double it and recycle it, it helps offset some of these life insurance cost and expenses, and it helps with the loan. Okay, that's some of the. Now I want to stop sharing my screen now. Okay, now this is just one idea. There's all kinds of ideas that you can use this for. You know, I have a lot of folks set it up to help pay off their house early, and um, I like calling this getting debt free on steroids. Okay, Now, I work with a lot of people that are on the Getting Debt Free with Dave Ramsey because a lot of people like to get debt free, and that's a great thing to get debt free and financial freedom. There's a thing on my link that I will be that you will see well at the bottom. There's a little graph about the steps to getting debt free, and one of them is using the cash value life insurance, whether it's a whole life or an IUL, to help uh, get out of debt, because you can use this cash value to help you pay down your debt. And I like to call it getting debt free on steroids, because one of the problems that I've run into with a lot of people that are trying to get debt free, they run into the same problem that my wife and I did. My wife and I, we were both working, and we were trying to get our house paid off early. So what we were doing was we were stockpiling the money in the bank for the house, right? We kept, we were putting extra money in on the house mortgage, the payment. We'd give them extra, give them extra. Well, when my wife got brain cancer, when my wife got brain cancer, we lost an income. And in losing that income, we wound up not being able to pay the house payment for a while. Well, eventually, the bank took the house because we were down to one income, and I kept trying to pay but it wound up, we lost the house because, and so many people are losing their house, and they're paying extra to the bank. They're paying extra to the bank. And then what happens if they get to where they can't pay the house payment, the bank loves it because, they got all that money extra. All that money extra is profit for them, right? And they don't care if you paid extra. But and I even told the bank, "Hey, I've paid all this stuff extra." Well, that doesn't matter. That doesn't matter. They're going to take the house, and they do. Over 400 families in Tennessee lose their home every month. Every month. That's not a year. That's every month because of something like this. So, what I tell people is if you are wanting to pay off your house early, and you want to get out of debt, and you want to stockpile more money for retirement, then you should work with me and use cash value life insurance to help have the safeguard where you can pay off your house early, and you'll have a critical illness, a terminal illness policy built into the life insurance. And you will also have the life insurance policy so that if you die, your children, your family, your wife, your partner will get some money to where they can pay off the house and keep the house. Or they can pay the payment and keep the house if they want to stay in the house. This is a great idea. This is why so many people in the fourth quarter of 2024, over $800 million went into this cash value life insurance, or IUL program. And I'll have a link in here where you can look at how much money the bank have in cash value life insurance. Yeah, that's right. The banks have money in cash value life insurance. Their money in the cash value life insurance, and then they'll take that money from the cash value and they'll loan it out seven to 10 times and make money off of that money. So that's how they keep making money. Now, I'm going to close this, and I look forward to working with you and to helping set up a program. And keep in mind, if you have uh, a cash value life insurance program already, if you want to, or an IUL, I can look over it and do an audit for you to see how it's performing, what it's like, if you want to make changes on it or whatever. And I do charge for that because my time is valuable, and uh, me doing an audit could save you a bundle. All right. Well, you have a blessed day, and I will end this for now, and hopefully we'll be working together. Have a great day. Bye. And a blessed day. Bye.